The fifth step in the accounting cycle is to journalize and post adjusting entries. The assumption of accounting is that the economic life of a business can be divided into artificial time periods. This assumption is referred to as the time period assumption. The revenue recognition principle dictates that revenue be recognized in the accounting period in which it is earned. In a service company, revenue is considered to be earned at the time the service is performed. If a company is a seller of goods, the revenue is earned when the goods are delivered. The timing of expense recognition is determined by the matching principle. The matching principle dictates that efforts, that is, expenses, be matched with accomplishments, that is, revenue. In order for revenues to be recorded in the period in which they are earned, and for expenses to be recognized in the period in which they are incurred, adjusting entries are made at the end of the accounting period. Adjusting entries are needed to ensure that the revenue recognition and matching principles are followed. Adjusting entries are required every time financial statements are prepared. There are two types of adjusting entries: prepayments and accruals. Adjusting entries for prepayments are required at the statement date to record the portion of the prepayment that represents the expense incurred or the revenue earned in the current accounting period. The adjusting entry for prepayments will decrease a balance sheet account and increase an income statement account. The prepaid expenses expire either with the passage of time, for example, rent or insurance, or through use and consumption, for example, supplies. The prepaid expense adjusting entry results in a debit to an expense account and a credit to an asset account. During the month of October, Pioneer purchased advertising supplies costing $2,500. An inventory count at the close of business on October 31st revealed that $1,000 of supplies are still on hand. The adjusting entry requires a debit to supplies expense and a credit to supplies. On October 4th, Pioneer paid $600 for a one-year fire insurance policy effective October 1st. The insurance was recorded as an asset, prepaid insurance, when paid. The prepaid insurance expires at a rate of $50 a month. The journal entry to record insurance expense requires a debit to insurance expense and a credit to prepaid insurance. Many of the company's assets will be useful for multiple years. The matching principle requires that a portion of the cost of a long-lived asset should be reported as an expense during each period of the asset's useful life. Depreciation is the process of allocating the cost of an asset to expense over its useful life in a rational and systematic manner. Pioneer's trial balance reports office equipment of $5,000. Depreciation expense is estimated to be $480 per year or $40 per month. The journal entry requires a debit to depreciation expense and a credit to accumulated depreciation. When recording depreciation expense, the credit entry is made to accumulated depreciation rather than to the asset account directly. Accumulated depreciation is a contra account. A contra account is an account that is offset against an asset account on the balance sheet. When a company receives cash in advance for providing service for a customer, it records a liability called unearned revenue. Examples are rent, magazine subscriptions, and prepayment by airline customers. At the end of the accounting period, an adjusting entry should be recorded to reflect the amount of unearned revenue that was earned during the period. The adjusting entry requires a debit to unearned revenue and a credit to service revenue. Add debit adjusting entry to liability T account and credit adjusting entry to revenue T account. Pioneer received $1,200 on October 2nd from R. Knox for advertising services expected to be completed by December 31st. $400 of these fees were earned during the month of October. The adjusting entry requires a debit to unearned revenue and a credit to service revenue. The second category of adjusting entries is accruals. Adjusting entries for accruals are required to record revenues earned and expenses incurred in the current accounting period that have not been recognized through daily entries. Revenues earned but not yet received in cash or recorded at the statement date are accrued revenues. Accrued revenues may accrue with the passing of time. For example, interest revenue and rent income are the result in services that have been performed but neither billed or collected. The adjusting entry for accrued revenues requires a debit to an asset account and a credit to a revenue account. In October, Pioneer earned $200 for advertising services that were not billed or recorded before October 31st. The adjusting entry requires a debit to accounts receivable and a credit to service revenue. Expenses incurred but not yet paid or recorded at the statement date are called accrued expenses. Examples are interest, taxes, and salaries. Adjustments for accrued expenses are necessary to record the obligations that exist at the balance sheet date and to recognize the expenses that apply to the current accounting period. The adjusting entry for accrued expenses requires a debit to an expense account and a credit to a liability account. Pioneer signed a 3-month note payable in the amount of $5,000 on October 1st. The note requires interest at an annual rate of 12%. The interest is to be paid at the end of the 3-month period. The formula for computing monthly interest expense on the note is shown here. The interest for 1 month is $50. Pioneer incurs interest expense of $50 per month. The journal entry to record the accrued interest expense at October 31st requires a debit to interest expense and a credit to interest payable. Employees' salaries are paid after the services are performed. Pioneer's salaries were last paid on October 26th. The next payment of salaries will not occur until November 9th. As of October 31st, Pioneer's employees have worked 3 days for which they have not been paid. At October 31st, the salaries for these 3 days represents an accrued expense and a related liability to Pioneer. The employees earned a total of $400 a day. Thus, the amount earned on October 31st is $1,200. The journal entry to accrue for the salaries owed requires a debit to salaries expense and a credit to salaries payable. The sixth step in the accounting cycle is to prepare an adjusted trial balance. The adjusted trial balance shows all of the account balances, including those that have been adjusted at the end of the accounting period.